Hello, everybody. As promised, we're going to have a little bit of educational video here to talk about life insurance and retirement plans. Clearly, both of those are deep subjects, and we can't get into everything on it. But we do want to give you a little bit of information that you can take next time you're faced with making these decisions. I have with me today Scott Wallach, who's a certified financial planner with HK Financial Services out of Indianapolis, and Scott's company and our firm has a strategic partnership where we work together to provide wealth management and advisory services for our clients. Scott's also a CPA, so don't hold that against him. What that really means is he and I tend to think a lot alike about a lot of things. So sit back, learn a little bit. We're not going to get really deep here. This is just to give you some information and whet your appetite, and we can follow up later if we need to. So Scott, let's talk a little bit about life insurance. And life insurance may not be as simple as people think that it is. And full disclosure here too is Scott and I both have our life insurance licenses. So we're absolutely not anti-life insurance. We're pro-life insurance. Everybody should have it. So, Scott, talk a little bit about the differences that we can see.
Yes, thanks, Greg. Appreciate you having me today. So, yeah, I agree. Life insurance has a application to anybody's overall plan. Most folks have it for protection, first of all, in their young lives when they have children or start a new business, just to help protect them in case something happens, pay off loans, build up savings, those types of things. And a lot of folks, that's term insurance. That's often the lowest cost option to get started. There's pros and cons to both. Everybody has different arguments, but for example, term insurance is what a lot of families will get to get going in there as they're starting to build overall savings. A lot of clients, Greg, over the years you've seen too, have come to us with different questions about, hey, they're guys out there and gals are proposing whole life insurance policies or universal life policies or variable policies. What do all these things mean? And we call that, just in a nutshell, we call that permanent life insurance. And some folks like that because it's an asset they can build cash in. They can have a savings vehicle inside of there for many long terms. A lot of people like that because it doesn't necessarily, it's not, if you have it throughout your life, you'll get something back for it eventually. There'll be cash in there. Versus a term policy where you may outlive your term policy and the insurance company says, thanks for playing and we're going to keep your money and you don't get anything else out of it. So,
Scott, I actually looked up term insurance today, and you probably know these stats too. Somewhere between 1% and 2% of term insurance policies are actually paid out.
That's correct.
That's why they're a lot more inexpensive.
That's correct. That's why they're inexpensive. And for somebody, like I said, if it's going to fit within your budget, start that way first. From that end. And Greg, I've seen people who have jumped into the whole life policies quicker in their younger lives, and sometimes that causes problems. They're not necessarily allowed, or not able to save money inside of their retirement plan vehicle. Sometimes that creates a situation there from a tax perspective where their income may be up. As you know, we can't take deductions for life insurance premiums there from that situation. So we see a lot of folks sometimes get their hands tied a little bit about that. So what you got to do in summary point is just make sure it's the right timing for you as you consider these options. Most folks, that fork in the road is, what does it cost? And what do I really want down the road from it? Do I want to have some cash in there eventually that I can get my hands on or the death benefit? Or do I just want protection right now and I don't want to put a lot of money into it? So that's the ultimate question there as we go through those pieces there.
I think one key that I've learned over my years in the business and being faced with the same kind of decisions is a lot of times, not always, but a lot of times life insurance salesmen can be a little bit pushy and push you into policies that you may or may not need, primarily, in my opinion, because they get paid to sell policies. That's what they're in the business for. That's not necessarily a bad thing, but I do think it's very important before anybody jumps into any type of investment or any type of life insurance to understand what it is that they're buying.
Correct.
Because it may be good for you. It may not be good for you. It may not be good for you now, but it may be good for you 5 or 10 years from now. So I think that's a big key is don't do something just because the crowd tells you should do it, no matter what it is.
Exactly. And I would tell you, Greg, on top of that is just if you've had somebody do a good analysis for you across the board, understand your total picture first from a financial planning perspective, doing that homework. A lot of times, as you've seen me do before, we can illustrate that need for folks and look at that and solve for it and say, do you need this amount of coverage or do you need this type of coverage? And we can prove that out by looking at their long-term picture. So I think that's done a lot that way. I myself years ago went through that exercise where I didn't have necessarily all my information. We had children and quickly went and got life insurance. And I remember after I signed those policies saying, this is a personal experience from, gosh, 10, 12 years ago now, saying, wow, what did I sign up for? Was that the right thing to do? And I didn't like that feeling. So I wanted to make sure. So now that I've gone back and done my homework and do what I do for a living for others, it made me say, okay, this makes sense. And my wife came up with a good game plan. And we did do some term and some permanent coverage, just to tell the crowd as they're wondering what you and I do.
Well, yeah, the worst thing in the world, no matter what you're buying, whether it be a house or a car or life insurance or anything, or a TV, is that buyer's remorse immediately after walking out of the store.
Especially when you buy those warranties on those things. Just kidding.
Exactly, yeah, exactly. And the seal coating on the bottom of your car.
But yeah, and one more point I'll say, what you said on a second ago, is just on that life insurance. When you sign up for those things, a lot of folks get that buyer's remorse, maybe 2, 3, 4 years down the road, potentially, when they start to look at it and go, oh gosh, what did I do? And you can't get out of that for another maybe 10 years or so, because you have what they call a surrender charge on those things. So you really want to be sure when you jump into this thing, it's jumping into the deep end and making sure you're ready to go off that diving board, so to speak there.
Scott, at a really high level, let's talk about the differences between a whole life policy as a retirement investment and a traditional retirement plan as a retirement investment.
Yeah, I would say from my experience, and I've been doing this a long time as well too, and I think if you really, again, you got to go back to understanding your full plan. And I think there's a combination for both of them in there potentially. What I would tell folks is probably don't go one direction and go all in one direction, being, do you go all into the whole life policy or do you go all into that retirement plan? I always believe there's a nice blend there to do. And again, looking at both of those options there, the whole life, the reason people may use insurance for a retirement vehicle is because it will have a cash value component in there. And those that have probably talked to an insurance agent, and this is accurate, is you can get to that cash value. You can borrow against it. You can use that. And the good news is it's tax-free when it comes out of there. But you have to be careful when you draw that cash out of there, because you can put that policy at risk. And again, we won't get that deep into it today, but if you draw that policy down too far, as you get older and maybe you stop making premium payments into that, you could cause that policy to lapse, and that becomes a tax issue down the road. So we don't want to put that at risk. The nice thing, why, Greg, I do like seeing sometimes folks using insurance in there is if we have a down market on the retirement plans, which I'll talk about in a moment, the life insurance may give you an option to have an asset to draw off of when your traditional portfolio maybe is down, like this year, as we've gone through some of the events we've gone through. So it helps provide what we call protection in one part of your overall game plan. And we'll talk about how those are invested in a second here on the whole life policy. But then when you go over to the retirement plan, and what we mean by that for folks that are listening to this is a 401k plan or an IRA or a SEP IRA or simple IRA. The reason you still want to consider those retirement plans is those are some tax deferral vehicles for you as well too. And if many folks like you and I work with, Greg, are in those high tax brackets, they're going to go ahead and give that money to the government right now. And I think that's probably a mistake there that you may want to consider, because if you do that over 10, 20, or 30 years, all that tax deferral is going to add up. And hopefully down the road, as the plan plays out, you'll be in a lower tax rate in the future. So I like to take advantage of both in a long answer for you there.
Well, I mean, Scott, you bring up something really good. I'm glad you did. And that's the tax bracket question. It's often sold to people that you don't want to make an investment into a retirement plan and get the deduction now, because tax rates are going to go up in the future when you have to withdraw it, and you're going to be taxed on it then at a higher rate. Right. And I can tell you that within my career, I have seen 70% marginal tax rates. Now the top rate's 37%?
Correct.
And in the last 20 years, the top tax rate has been in the neighborhood of 40%, give or take. And clearly, with all the money running out of the government right now, tax rates probably will creep up at some point in the future. What are they going to be in 30 years when you have to withdraw it? I don't know.
Right.
But I think it's a fallacy to 100% believe that tax rates are going to be higher when you retire than they are right now.
Correct.
They may be, may not be.
We don't know. Yeah.
Yeah. And I'm a big believer in you bet on what you know versus what you think might happen. So I'll take a tax deduction now versus maybe not paying tax later.
Correct. And as you know, there's strategies when folks retire, and if they have income that has dropped down quite a bit initially, maybe before they have to start taking distributions, we can play some strategy games there for them too, to do some Roth
Absolutely.
IRAs. But there's a lot of things we can do, and I know that's above the scope today, but yeah, a lot of things we can do there.
All right, now you alluded to it a minute ago, and that's how
Mhm.
the cash value in a life insurance policy builds and grows. Talk a little
Correct.
bit about how that happens.
There's several ways, and we'll kind of summarize for the folks that are watching this. In a whole life policy, it's very straightforward. You get an interest rate credit. Think of it like a savings account. You're going to get a nowadays kind of 1 or 2% credit. While that's a very comfortable, you don't have market risk. It's like having a savings account. The risk that you have in that, though, in the long term is, and this could happen, what you just alluded to too, Greg, with all the money coming in from the government this year, we'll have inflation in the future, most likely. So if I'm taking all my money and putting it into a whole life policy, I could have issues down the road where maybe my money's not pacing at the level of inflation. So that's one way to look at it from a whole life perspective. When you start getting into your universal policies, those are invested in the stock market. And there are different programs there where you can set things to say, hey, don't go below zero. But if you have a program where you say, hey, I can't lose any money, but guess what? The insurance company is going to put a cap on the top side. And last year would be a good example when the markets ran up 20%. Most folks were capped at 10%, so they couldn't get that whole upside. So there's pros and cons there for some of those programs. If you go to a traditional, just, hey, I'm all in on an investment strategy, and they call that a variable universal life policy, that's going to be invested in the stock and the bond markets. No different than would be your retirement account at your company or at your practice where you may be working too. So there's still exposure there, and I think a lot of folks get misled when they hear, oh, guarantee, or you can't go below zero and all that. There's pros and cons. You can't have the best of both worlds a lot of times there too. So that's in the stock market for those folks that are listening to this, and it's in the bond markets. And if you have some of these types of policies, you really need to understand how they're invested. And I've seen so many people over the years where they come to us and they show me what their policy is, and they don't have an idea of how they're invested. And this would be a 60-plus-year-old person that when I look at, say they're 100% in the stock market, we need to fix that in a hurry to make sure that policy doesn't get put at risk. So, Greg, not a whole lot of differences in terms of how they're invested. Some companies may have some different programs in there, but there's absolutely no 100% guarantee that you will be protected all the way through this thing. The other part is the insurance company too. You got to make sure that they're a solid standard company. Look at their ratings, A+ ratings, that they will be around in 30 years for you as well too. And hopefully that won't ever be an issue for most folks, because if something does go wrong with a company, they often get gobbled up by the next big guy out there as well too. But you really want to understand that company is going to be there for you too.
Right. Next thing I want to talk a little bit about is, you always hear with a whole life insurance policy that you can borrow against it.
Mm-hmm.
We know that.
Mm-hmm.
You can do that to an extent. What about retirement plans? Can you borrow against your funds in retirement plans?
The only one you can borrow against really is the 401k plan. Those rules are all changed this year, but let's just pretend it's a normal year. Typically, you can borrow up to $50,000 out of a 401k plan, but you do have to pay that back over a 5-year period, and you pay yourself back with interest. So a lot of folks that might run into a pinch, I don't advocate turning your retirement account into an ATM machine or a savings and loan institution. But if you have an issue where you had something big come up, it's a great way to not have to go put a bunch of money on a credit card and run up interest there and pay the credit card company. You could borrow and pay yourself back with interest. As long as you pay that loan back, it will be completely, it won't have any tax impact there. But as you know, Greg, if they default on the loan, it all becomes taxable. And we've seen folks do that as well too. So the answer is that, but unlike a SEP IRA or an IRA or a simple IRA, you cannot borrow against those, but just your 401k plan.
I jotted down a few takeaways for me.
Okay.
You can add to this if you feel like it. My number one takeaway is there are certain risks to investing in a life policy, and there are certain risks investing in a retirement plan.
Absolutely.
Some of those are similar risks, some of those are different risks, but neither are risk-free.
Mm-hmm.
Second takeaway I have is this is not an either-or proposition. You don't have to go in one direction or the other. Like you mentioned before, a blended strategy may make the most sense for most people. Mm-hmm. And the third is we have tools to analyze what you're actually getting into. So from an independent perspective, we can take it, look at it, do a side-by-side comparison, and see what works best for each individual person, because my needs are going to be different from your needs.
Hmm.
And that goes across the board with everybody. Everybody has their own unique situation.
Hmm. I would say, Greg, to summarize that too, keyword is analysis and looking at things and taking that thorough in-depth look at it. Just like I talked about earlier, my experience of doing that a long time ago and not having the technologies come way so much fast here, what we used for those analysis tools. I wish I had those tools back when I bought it. Like I said, I would have felt much better knowing, hey, this is what I want to do. So yeah, take the time to do that. Don't just jump into it and hope it's going to work.
Well, for all of our people out there listening to this, hopefully you made it to the end of it. And Scott, I'll speak for you, even though I probably shouldn't speak for you. But there are those of you out there that want an analysis done. I think between Scott and I, we can put something together and let you know what we think, and then you can probably make a better, more informed decision at that point.
Absolutely.
All right, Scott, thanks for joining us today. Hopefully we can do some more of these and just
Yeah, absolutely.
educate our folks a little bit more and help everybody make good decisions.
And Greg, maybe have the group send some topics they want to talk about. We can.
Hey, it's a really good idea. Yeah.
Yeah. Yeah.
If you have something you want to talk about, we'll put together something and do it.
Absolutely. 100%.
All right, Scott, thanks. We'll be talking to you soon.
Thank you, sir. Thanks for having me.
All right. Bye.